Well, of course, the debt ceiling saga continues with no deal on the table yet. Investors are getting antsy as the long weekend gives Congress fewer days to review legislation, vote, and get a bill on Biden's desk to sign. Joining us now with more on this is Veronica Willis, Wells Fargo Investment Institute Global Investment Strategist. So as we really look at the countdown here, I mean, we have a weekend coming up. We have Memorial Day coming up as well. Markets will be closed, really anticipating this. How much of a make or break is what happens by Friday for markets?
I think the markets are paying really close attention, and what happens by Friday will be important. I think what's also important to highlight, in 2011, deal was made over the weekend, and then shortly made into law the following week, and so we could still see something happen over the weekend, even over a holiday weekend. And so, Friday is not the be all end all, but I think the market really is going to want some sign that progress has been made by Friday.
And when we look at what markets have already had to price in so far this year, I mean, deciding whether or not there are going to be Fed rate cuts, really jumping the gun here. They haven't even had the pause yet, and they're already jumping ahead to potential rate cuts here, despite what we're seeing with stickier parts of inflation, especially in services. What's your estimation for the potential for a Fed pause or cuts at this point?
I think, it's going to be very data dependent. There's a lot of data coming out between now and that June meeting that can, push the Fed to either raise 25 basis points or to pause. And I think what will be key is to not misinterpret a pause in June as a sign that the Fed is ready to pivot. I still think that even if the Fed pauses in June, there's still a likelihood that they may have to raise rates still later in the year, because their primary objective is to get that inflation down. And while it has come down meaningfully from last year's peak, it's still stickier than where the Fed would like to see it. It's still above that 2% target. And, a lot of Fed officials have spoken recently, really reiterating that mandate that they need to get that inflation down.
And so when you look at how close we are, even just sort of seeing some of the volatility building up because of the debt ceiling standoff, and you add that to recession expectations, then we might not even know how long these reverberations will last as markets sort of get to terms with all of this. So what are the expectations here? How deep and prolonged then could a recession be?
I think, we are expecting a recession starting later this year, maybe extending into 2024. We're not expecting a very prolonged recession, and we think we can look toward a recovery in 2024. I think that will be really key for markets, that expectation that a recession will not be very long. And what's really underpinning that is the strength that we are still seeing in the consumer and the strength that we're still seeing in the labor market. Even through a recession, we're not expecting the consumer and the labor market to weaken as much as they may have in previous recessions. And so that should help keep that recession on the shorter end as opposed to the longer end.
I mean, when we look at equity so far this year, you caution not to chase the equity rally. What are some of the risks you think investors might be missing?
Well, investors are very focused on this near-term risk with the debt ceiling. Underpinning that, we've got, a risk of recession, a risk that the Fed is going to be a little bit more aggressive in policy than what the market is expecting. You mentioned earlier, the market's expecting cuts this year. We don't think that's going to happen. And expectations for cuts have come down as, more Fed officials have spoken for 2023, but there are still some cuts priced into later in 2023. And when that doesn't materialize, the market's going to have to react to that. So I think, a more aggressive Fed, a little bit more aggressive than what they may be expecting now, is something that, the market is going to provide a lot of market volatility through 2023.
So then for people looking at their portfolios, wondering sort of how to hedge some of this, not just the inflation risks, but recession risks as well. Some sectors that you say that you like here, healthcare, IT, and energy. How are you allocating some of these things?
Yeah, our key has always been, don't exit the equity market, but to shift that positioning to be a little bit more defensive. So shifting from the more cyclical sectors into things like tech, healthcare, energy, because we think that they're going to be more resilient through the economic downturn. And we've had this defensive positioning for over a year now, beginning of 2022, when we first started seeing the stock market decline. And that has, that's worked out well for clients, that's worked out well for us. And we think that those are the areas that are going to hold up better than other sectors within equities as we're navigating all of this volatility through 2023.
All right, don't chase that equity rally. Great stuff there. Thank you so much. Veronica Willis, Wells Fargo Investment Institute Global Investment Strategist. Thank you so much.